Nothing hurts more than winning a home that you love, but receiving a low property valuation. A low valuation can derail your home buying journey by forcing you to have to start the loan application process again, as well as be financially penalizing by making you contribute extra cash towards your purchase. While you can't totally eliminate the risk of receiving a low valuation, there are definitely ways you can manage these risks. My name is Tommy Lim. I'm the Managing Director of sfcapital, and welcome back to our next home buying series. In this video, we'll go through first, what is a property valuation report? Second, what is the impact of a low valuation? And third, how do you manage a low valuation? First off, what is a property valuation report? In the case of a new home purchase, this is a report ordered on behalf of a bank to independently verify a property is worth what you have agreed to pay for it. There are three main types of valuations. First, a full valuation report is one where a human valuation inspector physically visits the property, inspects the inside and outside, and does a write-up on what they think your property is worth. Number two, a curbside valuation still involves a physical valuation, but only requires the valuer to drive by to verify the property is there and in good condition. Thirdly, a desktop report or automatic valuation model uses statistical models or a computer to determine what your property is worth. A full valuation is typically conducted for high-end or new properties, as well as for properties where a valuation is contested. By contrast, a desktop valuation is suitable for frequently traded units and apartments and for more affordable houses. A curbside valuation is for established mid-range properties. A common thread amongst all three valuation reports is they use settled comparable sales in the last 6 months to help derive what your property valuation should be. We'll unpack this more in a second. Next, what is the impact of a low valuation? A valuation report is crucial for determining the maximum loan amount a bank is willing to safely lend to you. This is in turn driven by the loan to value ratio, or LVR. For standard properties in metropolitan areas, banks typically lend up to a maximum of 80% LVR without imposing an extra charge called lender's mortgage insurance. The benefit of a loan means you can buy something today by borrowing money you don't have. This is great if prices go up or are stable, but if prices go down, you'll need to top up the difference between the new loan amount and your agreed purchase price. It's best to look at this via an example. Imagine your next home costs you $2 million and the bank's LVR is 80%. If the valuation report comes in at $2 million, this means your maximum loan amount is $1.6 million and your deposit is $400,000. However, say the valuation report only comes in at $1.9 million. In this situation, the bank will only lend you $1.52 million or $1.9 million times 80%. If the original purchase price was $2 million, then your new deposit has increased to $480,000. So you have to make up the original $400,000 deposit plus 80% of the $100,000 shortfall amount. This situation hurts, right? So how do we deal with it? This takes us to our final section. How do you manage a low valuation? Well, prevention is better than cure, and there are some common sense ways you can de-risk the chances of getting a low valuation. My most important piece of advice is to have your loan scenario assessed by an experienced broker so you can accurately know your borrowing capacity, and then get a pre-approval so that your desired loan amount has been confirmed by a bank. The next most important tip is to stick to your property budget once you've started looking for a home. It's okay to love your next home, but being disciplined means not being emotionally drawn in by heavily styled properties, not getting carried away at auctions and going past your limit, and not conceding to any contract clauses unnecessarily, such as your cooling off period or your standard settlement period. But say you do end up with a low valuation. What do? There are two main strategies. The first go-to strategy is to order multiple valuations with other lenders where you are also eligible for a loan. This is about getting a second, third, and even fourth opinion on what your property is worth. Unfortunately, valuers are human. Subjectivity can creep in, and different valuers can arrive at different conclusions of what your property is worth. While another lender may have not been your preferred choice, and it can initiate the stressful process of having to apply for your loan again in a shorter time frame, we find clients prefer to pay a slightly higher rate than to have to contribute more savings to a property purchase. If you feel you have overpaid for your property, you may even want to order multiple valuations simultaneously rather than wait for a valuation to return low and only then order another valuation. The second strategy is to challenge the valuation report through evidence and data. This means contacting the selling agent or doing your own research on comparable properties that have sold and settled in the last 6 months. Typically, when challenging a low valuation, recent comparable sales are set out in a table or a list with reasons why your property should be valued higher. If there is an inferior or similar property that sold at a higher price or a higher square meter rate than the property you have purchased, then this is a very good reason for a valuer to review the valuation report and increase your property's stated valuation. The reverse is also true. If a highly comparable or superior property sold at a lower price, it's very likely that your low valuation will stand. The more comparable properties on your list, the better. And you should also list out qualitative reasons why a property is inferior or superior, whether it be due to aspect, age, size, or quality of the finishings inside the property. I would like to warn you though, it is notoriously hard to challenge a valuation. And few valuations, even when well challenged, get revised to the contract price. This is just speaking from experience, and we think there is a human element to it that valuers don't want to say they are wrong after doing all the work. Instead, the main goal of challenging a valuation is to try and close the gap. For example, if the $2 million property I previously mentioned got revalued to $1.95 million rather than $1.9 million, then the deposit reduces to $440,000 instead of $480,000, a saving of $40,000. So that wraps up this video on what to do with the low valuation if you ever encounter this challenging scenario while buying your next home. If you found this information useful, please follow SF Capital on social media and YouTube for more next home buying tips. Thank you and see you next time.